All right, good afternoon, everybody. I think we have a little bit of a queue coming into, oh, there we go. Everybody, good afternoon. I think we have still a few people queued in the waiting room, so we're going to give it 30 more seconds and then get going. So appreciate you guys attending. Okay. All right, looks like we have cleared out. So good afternoon, everybody. Thank you for joining us for our series of budgeting and turning your budget into reality. Joined with by Ben Garthwaite today to help me walk through the materials, but excited to have everybody here. Ben, if you want to kick us off with just a quick introduction, and then I'll jump into the materials.
Hi everyone, Ben Garthwaite. Work very closely with Craig, and I lead the Pegasus Insights team here at Impact Point. For anybody who doesn't know, Pegasus is our proprietary software tool that focuses on cash and liquidity management, automation, and forecasting. So, really excited to get the opportunity to present, actually executing on your budget today here with Craig. So we'll get started and jump into the content.
Yeah, thanks, Ben. And Craig Harworth, I'm one of the partners of Impact Point, and I co-lead our Office of CFO practice. Have also sat internally in companies, everything from public to private equity and private, leading FP&A. So I've done a fair number of budgets in my lifetime, and also kind of the management, course correction, and reporting. So those are the types of topics we're going to cover with you today. We're going to try to go through quickly just some background information. Some of you that have joined us on previous webinars might recognize the first couple of slides. Then we're going to get into cash considerations, looking at tools for tracking, measuring success. If you need to reforecast or rebudget some of those considerations, and course correction throughout the year. If you do have questions, please feel free to drop them in the chat, or you can also email them to me. There's my email, charworth@impactpoint. So kind of reframing, just making sure we're all aligned on the same baseline. We've previously covered materials as far as it pertains to phase 1 and phase 2 of the budgeting cycle. With vision and accountability. And this is really the building of the budget, making sure you're at a granular level that can hold people accountable. And now we're going to transition into that delivery and the execution processes. And this is really where you've hit the budget, you've completed it, you're bringing it to life, and now you're measuring your progress as you progress throughout your budgeted period. And you'll see the key things there as far as insights or the variance analysis and the ELT, Executive Leadership Team reviews. We'll show you some sampling of both tools and agendas for those, and also the initiative trackers that are part of the enablers. One of the things that we are going to also cover here at the end is the gap to budget initiatives. Ben's going to talk through some opportunities and some options as far as if you're off track, how do you get back on track? Or maybe if you're looking to exceed your budget, what are some of those options? So quickly here, and again, this is the last one that we'll cover that we spent a lot of time on previously, but your budget should really be driven by guiding principles. And going around the wheel, the first one I'm going to talk to just a little bit here in a second is that to be completed timely, thorough, and actionable. It should be based on top-down targets with bottoms-up reconciliation. We really need a repeatable and consistent process that allows us to come in and do this over and over, and so we can replicate, ensure accountability and transparency, and be data-driven. And if you're thinking about the key ones here as it pertains to execution of your budget, starting on the top left there, allowing yourself time will allow you to put in place any course correction before the end of the year. So if you're thinking about completing in November and having an opportunity to course correct so you're ready to run in January 1, assuming a calendar budget, that is of critical importance. And then what we'll dive into is the monthly review and updates. The data-driven, what we see a lot of times is companies pull together budgets that are macro and high level. And when they start to get off, there aren't the factors there, the drivers on why. And so making sure you have a data-driven KPI environment that really allows to be able to jump in is critical. And the final piece there is this is what allows you to drive the accountability. And when you are getting off target or exceeding target, you can point to those departments, business units, leaders, and they have that accountability. So jumping into the timeline, as we've talked about, when we think about a budget, we typically tell people that this is an 8 to 12 week exercise. I think a lot of private equity backed companies underestimate how long their budget's going to take. They think it's a very quick hit, 4 to 6 week. I would say if this is your first iteration of a budget, you can easily tack on 4 to 6 weeks there as well. But if you see that in our ideal scenario, we had this being completed sometime around the November timeframe. And again, that allows over here on this right-hand side for implementation windows. So if you have to go through a cost reduction, headcount reduction, if you need to hire people, that allows you to have that implementation window. And the one other thing that I wanted to cover here as well is part of setting up your budget and making sure that you have those measurable pieces are going all the way through a three statement. Again, a lot of times in immature organizations or first budget attempts, we see a P&L budget, and you can really miss the window on what your capital needs are, if you have CapEx, your cash flow management, and driving those working capital type of drivers on your balance sheet, which become a part of your KPI and reporting package. And again, as you transition from finalizing the budget into the implementation, developing those trackers, both for critical initiatives, as well as the actual tracking mechanisms are very important as well. Let me go. Sorry, it's not advancing here. Give me 1 second. So, and as we talked about, having that three statement, knowing your cash needs is critical importance. I'm going to let Ben walk through a couple slides here quickly that brings that to life.
Yeah, so we wanted to talk about this because it's an observation that, is quite common and really we're seeing, especially in 2026. A lot of businesses are forecasting aggressive growth this year because of some, changes in the economic environment. So really looking to capitalize on that. One thing, running a software that's designed to help with your cash and forecasting software. One thing, we found as we stand this up and help organizations really get ahead of their cash and liquidity needs is that, growing on the P&L side is often something that is somewhat an afterthought in that budget. It's very common for businesses to think that, a lot of the EBITDA, you're going to realize that you go straight to the bottom line. But obviously, a big consideration is ahead of that, you're going to have quite a strong cash need. So while there's not a one size fits all algorithm to tell you what, cash reserve or liquidity reserve you're going to need for your budget, there's some important considerations we wanted to walk through, and then on the next slide we have sort of a semi-real world example to show you how to go about sizing it. But these are the big pillars that will determine what's the appropriate cash liquidity need you need to have access to in order to drive your 26, 27 and future goals. So the big thing on the left here is your cash conversion cycle. So DPO, DSO, DIO, they're not just KPIs, they're really those operational levers, and improving them is going to help you lower your cash financing need, going to mean you have less cash tied up, and be able to invest more of it back in the business. Then how well you can think about your inventory sizing. So what's the right amount of inventory to hold? It varies, business by business. Some things to consider, do you have customers who they're really sensitive to service time? Does a day or 2 day or 3 day delay, mean that you lose out on that sale? Obviously, when you've got sensitivity there, you're going to want to hold higher contingency reserves. Also thinking about your supply chain complexity, the more inputs, the more different pieces you have in making your product is ultimately going to drive how much inventory you need to have. Simplifying your supply chains always going to be a great way to bring that inventory level and cash need down. And then, of course, AP discipline. While you don't want to be stretching terms, randomly when you're in a cash crunch, sometimes, you do want to stretch certain terms. And at least if you're not in that situation, you want to have a plan for how do we do this methodically? What's our influencing power? Do we have the ability to do this, something you want to go into, any growth scenario with that in a plan already in mind instead of finding midway through. And then, of course, as you continue to grow and scale, can you keep up your AR collection, rigor there? So some really important considerations on the working capital side. And that's one of the things we help through, our tool on Pegasus is helping businesses through improving understanding and operationalize these metrics. Some other things you're going to want to think about are your CapEx, your one-time spend. So, do you have planned investment enabling your growth? What is your level of planned and unplanned maintenance? Do you have the ability to, replace a machine that goes unexpectedly down? Is that going to jeopardize realizing your budget if you can't because of short-term liquidity concerns? Also, do you have any major growth investments, one-time, below the line items, whether that's investment in tech, consulting, projects, efficiency gains? All of that might not be on the P&L, but has real-world, cash implication and burn. And then obviously, what's your ability to source cash? It's a different conversation on what you need if you have access to a revolving credit facility versus if you need to finance this all in cash. So depending on your structure there and how quickly you can draw against that is obviously going to determine how you think about, your need here. And then lastly, on the right-hand side, one of the big, overlooked item is just that operational complexity side. So, you typically have to hold less cash in reserve if you've got a cash culture across your organization. And really what we mean by that is every operational side person has their KPIs, they understand how their behaviors and what they're aligned on, incentivized on, convert back into cash, as well as being able to have visibility into it. So the longer your reporting is, the more time you have lagging, the more that contingency safety reserve you're going to need. So if you're able to close your reporting, timeline, get something that's more real time, naturally the business will be less risky. You're more risk adverse in that area. So you're able to, run the business with lower, cash reserve and contingency reserves, because it gives you, ultimately more time to respond. The earlier you find out about an unexpected cash need, the more you have, time to respond to it. It's not something, you want to find out 2, 3, 4 weeks later. If you can close that in no matter of days, that's fantastic and reduces that, buff you need. And then also just expecting the unexpected. You might have attrition or, hiring needs, seasonality that comes with new business lines, any margin compressions that might happen at scale. All of these are things that you should be considering in the back of your mind and should bake some contingency in for reserve. But if Craig would be so kind as to go to the next slide, we can bring it to life with an example here. So we wanted to, highlight this as a lot of businesses are planning, for growth in 2026. So trying to bring this to life for everybody, because if we look at this widget co, which I'm sure we're all familiar with from our days in university, you can see that we're planning to grow in 26 from 30 to 50 million, materially keeping everything the same. Right. So while that might only be 67% growth, which is an impressive target, you'll see that the cash need is actually 185% higher. And we'll walk through some of the drivers there. So thinking about this business, we've got our revenue target originally at 30 million, operating on a 35% growth margin. That puts, an EBITDA of 4.5 million. Looking at our cash conversion cycle, it's 75 days. So we then got DSO of 50, DIO of 60, and DPO of 35. So we've got about 6.2 million of working capital on hand, and then about 4 million of cash on hand. So what do we need to do in order to be able to get to this 50 million target, so that $20 million worth of growth there? Well, we're going to need to invest in, let's say, 2 more machines. We're going to have some SG&A expense that goes up, because we've got some ramping period. So in this scenario, we tried to keep it simple and have 2 machines for a total CapEx spend of 1.5 million upfront, and then some SG&A ramp of 6 sales reps at 150K each. So what does that mean for the business? Well, if you look to the waterfall on the right, you can see that we're starting off with our $4 million of cash reserve. And then now we've got to build inventory. So we're, if you think about our COGS, ratio, so that 35%, that's going to drive our inventory DIO needs. So running the numbers, that'll get you $2.1 million of additional inventory you need to purchase to have on hand. Because remember, you're keeping your DIO the same at 60, so your ultimately COGS for the year are going to proportionally grow with that revenue there. Also on the AR side, we're looking at our DSO of 50 days. So as we think about that additional, 20 million in sales there, we're going to have, 50 days of that on hand at any one time. So that needs to be financed somehow. So that's 2.7 million in financing, for that AR we're effectively bringing on. And then plus our cash outflows that don't necessarily hit our P&L depending on how we're recognizing it. But we've got our 1.5 million upfront CapEx investment, some of that SG&A, and then that is offset a little bit by our increasing AP. So that's obviously when we're growing AR, our AP is also going to proportionally grow with our revenue. So a portion of our cash need is going to be offset by that supplier financing. But one important thing here as we think about growth is we're almost doubling our total AP bills. So in reality, consideration is, are your suppliers actually going to be comfortable with you suddenly doubling the amount of AP you have in hand? So that's another thing just to keep in mind as you continue to grow. You might actually have some of that DPO might be more of a concern if people are following up more. And then lastly, you generally want to have a little bit of a buffer, timing on these things, unexpected payments, especially we're growing at 67%. What if we have attrition? What if there's just additional, fixed or hidden costs that we weren't aware of? All of this could, last thing we want to do is have this surprises throughout the year, and then we find out that we're now in a liquidity crunch and we're putting, key business items at risk. So all of this is to say that, three-statement modeling and cash planning during that budget cycle is essential for you actually being able to execute and operationalize that plan throughout the year. A great mitigating factor here is just having robust 13-week cash flow modeling and robust, reforecasting processes in place. The better you get at that, the less likely you are to need substantial significant buffers, and you're going to have more time to be responsive and avoid those credit crunches and those situations that nobody wants to be in. So with that, I'll throw it back to Craig to go through some of the next ones.
Yep. Thanks, Ben. So as Ben talked about, we're trying to build tools and processes to get ahead of some of the unexpected, so to identify trends and then figure out how to mitigate and manage those and potentially close the gaps. And so setting up the process, and I'm gonna go through the next few slides here talking about the monthly operating reviews, a reporting package, and then development of some of those underlying materials. And so as you're looking at this structure here, it's how I typically set up the monthly operating reviews. I know that terminology can be a little bit different depending on what company you are on. Some of the PEs participate monthly, some of them only in the quarterly board meetings, and then depending on how your organization is set up. But I typically, if you look at the top part there, the standing participants in these monthly reviews are the CEO, CFO, if there is a COO present, and then again, if the PE does participate. I typically have the remaining executive leadership team, and then your head of FP&A and accounting set in through the entire meeting. This really helps with having the knowledge base in the room, being able to get behind the financials, some of the statistics that are there that as questions come up. And again, taking a step back, this is all predicated upon having information that the books are closed, information is disseminated to the teams prior to the call. A lot of times when I've seen these not done well, the materials are distributed the night before, and everybody's looking for more of answers than explanations. And really, the parts of this process is to answer the whys, not the whats. So again, you have the top section here, the standing participants, and then I progress through these with kind of a standing of agenda with each executive leader presenting their section. So if you have your sales lead might come in, and if there are underlying budget owners under that, you go sequentially through those. And then same thing with the business unit leads and then the functional leads. And so this way, this gives the entire executive team insights into the entirety of the business. you're talking through, the agenda items there that you see at the bottom, and it really becomes a drill down. So you start with a consolidated session that really sets the stage for how the overall business is performing, what some of the key topics are that are going to be talked through. And then as you go through, there's the financial review. And I'm not going to go line by line on these, but you can see it gets pretty detailed around what the financials are. And a couple key items there. EBITDA to cash is a big one that we see a lot of companies that don't do. And again, as Ben said, the expectation when you're doing a P&L is your EBITDA does convert to cash, which I think is a true assessment or true assumption, I'm sorry. But it's the timing of that. And so if you see that cycle, how much of that EBITDA is converting to cash, and then looking at some of your balance sheet and working capital drivers, you really start to get ahead of some of the trends if you see something going in the wrong direction. Then we'll do the operational review with operating KPIs. There can be other sections here talking about one of the things that's top of mind in our current environment is supply chain. Could be safety considerations. Another one I want to highlight there, those project updates, and this is for mainly my POC 606 type of organizations that have construction type. You really want to do project level reviews with your estimates of completion, understanding where you are in that delivery of a project. We've seen a lot of companies not do that part of the monthly operating review, and it comes back with a lot of deterioration on EBITDA towards the end of a project. Again, kind of project updates. Jumping over the right-hand side, this is where you cover commercial, looking at the sales pipeline and backlog, what your key customer ones are. You may have an M&A discussion here, and then kind of looking at updated forecasts. Finally, these are really organization dependent. You might do an HR update as far as succession planning, additions, subtractions, looking at safety metrics, and then always closing with what action items are there and next steps. And really the way we enable that monthly review functionally is to have a really well-built reporting package. And so again, this is a framework that we think about it. So doing a drill down, if you start at the top of the page here, your dashboards are your most summary views. And then you're working down into more granular as you progress through the page. And then there are some one-off or other additional reporting there towards the end. But what we see again is if you frame up how the performance is going with the dashboarding, that gets everybody's mindset on, are we doing well? Are we not doing well? And reviewing those KPIs. I'm going to spend a minute here on the next slide and talk about KPIs and how you think about doing those. Those should be a part of your budget process, but what we typically see is a budget's completed, and then people then figure out what are the key measurements are that I need from an operational, financial, and other perspectives. And where I like to spend a lot of the time in the meetings is really the trends. The first part on the dashboards that give you the point in time pieces are good. They're informational. But really what you're looking to see is how things are performing over time. What's the movements? Are you seeing better costing? Are you getting better pricing power? So looking at those trends, how are things falling through to the bottom line, or what I really focus on as far as those time lapses. Again, statement of cash flows, very critical as we've talked about here. The lender section, a lot of people like to have that embedded in the reporting package so they can see what the lenders will be seeing, inclusive of add backs and normalized performance. And then the other section, again, I would spend time on the 13-week cash flow. Again, that gives a really good picture into the granular liquidity of the company, and then sort of whatever else is specific to the organization. So transitioning here for just a minute, as I talked about a second ago, KPIs are critical to running the business, and they are both the leading and lagging indicators. And so you want to have a good combination of both. And this gives you that red flag of something that's going on and potential poor performance coming. And also, if you are underperforming, it will certainly call those out. And so this is just a framework that we've developed Impact Point is very big on developing frameworks on how we think through different parts of the business and the operational and financial pieces of it. And so as you see here across the top, we're doing what are we trying to achieve? And so that's your strategic priorities. And then the rest of it is really bringing that to life. So how are you going to go about doing that? Initiative 1 through 2, 3, 4, and so on. And then how do you think about bringing that down to a level of granularity that can be operationalized and a company can be tactical in deploying? And so that's coming up with one of those discrete action items, and then monitoring going forward is key to the execution success. And so depending on the size of some of these initiatives and how they're translating to KPIs, you might be reviewing these on a weekly basis. We see some being, as far as like sales metrics, being delivered on a daily basis, especially in a organization that is growing significantly. But hopefully this gives you some ideas that there is a bit of a science to saying, okay, I'm going to grow by X%. Now, how to actually go tacticalize that and make it come to life. Couple I'll just spend briefly here are a couple of outputs that we have in the reporting package in MD&A. And so I pulled into here. The first one, again, as I go back to that high level dashboarding, this is something that's an example of that. This really helps set the stage. And what we like to do is bring in both a combination of metrics and numbers, tabular information, as well as graphical information as well. And so if you're thinking about, EBITDA change from X to Y during the year, the bottom right-hand piece is really trying to help understand that. What are those drivers? What are the things that are increasing and decreasing EBITDA? And then that translates into your next slide here, which is the drill down for each of those pieces. So in this one, it was third-party spend seems to be significantly up. How do we go about thinking through that? What are those key drivers? And we'll talk about spend cube here in a little bit, but looking at both the business unit at the time and the vendor when that has occurred helps you understand what the driver is there. So let's say that we've gone through our several instances of our reporting, our monthly operating reviews, and our reporting pack, and we are either meeting expectations or not meeting expectations. And so what I pulled together here was just a quick summation on how we think about the different ways to forecast and reforecast. Again, we talked about the budget pretty in depth. Again, that's 8 to 12 weeks. It's very granular and a top-down, bottoms-up reconciliation. That's an entire organization getting involved, having department and budget owners, and that becomes the baseline of your organization. It's something that is set at the beginning of the year whenever it's finalized and doesn't change throughout the year. The way you enact that change is either through a rolling forecast or a reforecast. Rolling forecast is just sort of a latest thinking view. I've seen people do weekly as far as sales updates. I typically see more often a monthly or quarterly rolling forecast. It's typically at a very high level update, can be facilitated somewhere between 1 and 5 days. It's the ELT providing known changes, updates, kind of the sales forecast being updated, and then FP&A bringing that to life. And it's really that continuous alignment, making sure the organization is ending up where the target is and coming in line with expectations. Really, at the right-hand side of the page is a much more fulsome effort. It's a reforecast, and this has been where there's material change to the organization. So significant underperformance. If you look at the bottom right there, it's a deviation from your expected performance. You've had material M&A. There are macro or micro conditions that are causing issues. And then you've seen those red flags that we've talked about: cash deterioration, margin deterioration, higher expense type of environment. And this is something that you need to set those parameters kind of going into the year. When do you reforecast versus just doing a rolling forecast? So it's as needed, and it is somewhat granular, not quite as long as the budget, but it's really a look at all department level budgets, coming up with a redo on what the balance of the period should look like. And again, as we think about that reforecast, one of the tools that we like to do is what's the gap, and what's achievable, what's not achievable. And so if you're looking at trends, let's just say that you had a budget there that is, in the $63 million column, and you're at some point in the period, you've had significant deterioration. So it's now time for a reforecast, getting the ELT and the stakeholders to align on what that new goal is, and then figuring out how to go bring that to life. And so you have on the right-hand side, just a call out box for key takeaways. And this is where you could potentially identify initiatives that are in flight that could close that gap, initiatives to be deployed, and then ideas for how to close that remaining gap. And really important here is to determine, is this a short-term, long-term type of issue? Is it a blip? How much do you want to change the underlying part of the business? We're obviously not looking to destroy future growth, but you're trying to remediate to certain goals in your current year. So what are the risks? How do you mitigate those? And then really developing trackers on implementing any agreed upon plans to make sure that they're on track. The project management of those is being well handled, and you're getting closer to that goal and potentially beyond. So with that, I'm going to turn it over to Ben. He's going to talk to us a little bit about some methodologies and ideas on closing that gap.
Yeah, so one thing that Craig was just talking about is the importance of being able to act and iterate efficiently and effectively. So prior to leading Pegasus and prior to finance, I was actually in the U.S. Marines. So one of the lessons in leadership and decision making that they teach us is called the OODA loop. And this originally came from fighter pilots who operate under pressure and quickly have to make split-second decisions. So it's designed to explain the thought process that officers in the military are supposed to go through, but it applies really well to almost any situation that you're going to see in the business environment as well. So very simply how it works is the first thing you're going to do is whenever you have something that might interfere with your main objective. So anytime there's a material change that stops you, from achieving what your goal is, right? There's also a saying in the military that, no plan survives contact with the enemy. So anytime there's a change, you want to repeat this cycle. So the first thing you're going to do is observe, understand what the current situation is, what was the reason behind the change, how important is the change. Then you're going to want to orient yourself, where am I currently compared to where I want to go? How far are we from the destination? Does this change anything? And then you're going to push that information you've gathered there into a decision mode. So what's the expected path you're going to take? Challenges, how am I going to mitigate? And then lastly, you're going to act. So, execute, go forward and action the plan that you've just come up with. So this is designed to be a cycle, and this is designed to be a cycle that's repeated until you ultimately achieve your goal. So if you want to go to the next slide, Craig, we'll talk about how this applies, throughout the budgeting season. So as we think about the OODA loop, observe, orient, decide, act, really how that translates to the FP&A calendar is reporting, your reporting cycle, analyzing your reporting cycle, and then ultimately decide is still the same, and then executing is still the same as well. But first on the reporting side, we talked about having the right structure in place. So you want to have all of those reports that you can generate, both long-term and then short-term. One of the key, advantages that, the military has and why they push the OODA loop is designed for short decision-making at, the right level quickly as we need to respond. So the faster you're able to complete this cycle, the better you're going to be able to achieve your objectives. So that's why it's important to have both your top down and bottom up. Your P&L budget, 3-statement, 13-week, EBITDA cash, and your short-term KPI reporting. Currently we're sitting on February 26th. Some businesses, they haven't even reported January financials yet. So if you think about achieving an annual budget, sometimes you'll be 2 months into the year without any directional numbers on how you're going. So if you're relying for that P&L budget as your first early warning indicator, and you end up with a miss, well, you've already burned through, almost 20% of the year without being able to respond to it. to it. So that's not the situation you want to be in. You want to be able to be nimble and fast and have those, 13-week and short-term reports to be able to, first start that cycle as early as possible. Then you're going to move into your analyzing section. So how do you translate those numbers into operational ownership? What is the meaning, the why behind the numbers that you're looking at? Is it timing variance? Is there actually a change to my operating model? If we're seeing something, that's not going to plan, is it on the profitability side? Is it a liquidity gap? We talked about the importance of, being able to size liquidity for growth. So if you are, rapidly going through the year, your cash could be burning because because that's expected with growth and you just weren't appropriately planning for it. But what are your leading indicators? How does that go back, and how does that importantly relate to our current goal? From there, you're going to have to make a decision. Is it things just got pushed to the right and we're still going to achieve the same plan? Or is there more of a comprehensive shift? So deciding on what are our gaps to target. There's also actions we can take to improve this. So, and we'll talk about some of the options available to you on the next slide, but there's things you can do to improve liquidity, cash conversion cycle. If it's a true shift in your business model, there's projects you can do there, as well as opportunities to expand your margins and push your top line. Really, your reporting and analysis is going to help you inform if you do have the gap to target, and then what you would need to do to respond to it. So some other considerations when you're deciding, what are the short-term and long-term impacts? How quickly can these take effect? Risk versus reward. You don't want to cut costs at the expense of the product and your future, means to produce. So everything's sort of in this decision making. And then as we think about executing, you want to have the right tools in place. You want to have the right process and owners and accountability. So having those tools to quickly monitor and quickly review and action these items, are going to be incredibly important to executing it, as well as it's going to be as successful as your process and your owners and who's accountable. So we'll talk about some of that on the next couple of slides. So Craig, great. So what we wanted to do here is frame out some of your operational levers that you can use to mitigate some of these gap to target. So we sort of at the top framed out some of the ones that are shorter to implement. The left side is some of those lower complexity type projects, and then on the bottom right is those longer term high complexity projects. So depending on the situation that you're responding to, sort of gives you the option. So running Pegasus, we're cash liquidity focused. We can do a lot to improve your liquidity and working capital situation. That's one of those things that is generally a very quick implementation. It's lower on the complexity scale, and it's got some real material, really material savings benefits. Especially helping you enable those growth. So things like AR discipline, not just randomly stretching, tiered stretching. Do you have the ability to classify your vendors by critical and less critical, to help close that liquidity gap in a way that's not going to hurt your relationships that you need to enable future growth? Your collections, is your AR and reporting enabled in such a way that you can actually use it to accelerate your AR, and you're not just reporting on DSO, you're actually able to trace that back to the teams and actions that will drive a material impact here. How is your order to cash or how is your order to invoice to cash process looking? A lot of times we'll see companies struggling with liquidity, but it ends up taking 30 days after service to invoice. That's a real quick way to immediately change some items and boost their cash position, as well as having better forecasting. So you have a better 13-week view, you have a better short-term forecasting. That's going to allow you to lower your inventory levels. You don't have to have that safety stock to respond to, especially time-sensitive customers. But lowering that inventory, that's going to lead to less spoilage, less waste, less unnecessary overhead, both in inventory and things like storing it and that. So even on the liquidity gap side, there are a bit of expanding options here as well, which leads me into the next one. If we're looking at margin expansion, there's a lot of projects that we've done, on the consulting side as well as the Pegasus side, to improve things here. And we could do a webinar on a ton of different options, but just to give some at a high level, one thing that's often great is spend cube, cash cube identification. We've got tools that'll automate this for you, but this is a great way to, optimize and spot redundant cost and ultimately remove it from your organization. Also going and, being able to optimize your procurement process, getting better deals, not having sporadic disaggregated supply chain, being able to centralize that on a few suppliers at better rates, and ultimately improving your operational process and your cost structure. There's also organizational design is a very common option. Looking at especially growing orgs, going into the theme that we were looking at earlier. Typically, when you're adding headcount and you're adding people to your organization to respond to increasing demand, you're not doing it in a clean sheet of paper ideal fashion. You'll design roles as needs come up. It's very natural. Every business does that. So org design is an opportunity to intentionally redesign and rebuild the organization. You'll often find that there's unnecessary layers, there's opportunities to widen management spans. Not only is this going to help, removing unnecessary cost in terms of middle management and unideal structures, but actually when you start to remove these layers, you're no longer playing telephone when there's an order going down the chain. You're actually boosting efficiency and overall satisfaction because teams are working more efficiently with each other and there's less red tape and bureaucracy, and your teams are able to move and respond quicker. And then there's also the classic time motion study. So you're able to go and look at roles within the organization, understand what their charters are, what their ideal workflows are, and find opportunity to take time out of the organization as well. And then also on the EBITDA expansion side, one thing you want to be mindful of, especially when you're doing this for long-term sustained growth, is you don't want to be cutting costs that could potentially compromise the product that you're ultimately selling. It's very easy to go into an organization and just take cost out randomly. You definitely don't want to do that. You want to do it in a very meaningful, measured way, that has no impact to your long-term view. Really, you're looking for redundant costs. So like a great example of that we reference quite a bit is merchant services. So may or may not know, but Visa recently changed a lot of their contracting structures. A lot of times when organizations look at redoing their payment processing agreements, they'll find that they can save anywhere from 0.25% to 1% in terms of fees. So that has absolutely no impact on your product. It's something that has very little operational impact, and saving almost 1% in a lot of cases is a great boost to your margins. So there's a lot of little things you can do outside of the product to find those marginal gains that really help you get to that next level in terms of efficiency. Now sort of going down to the longer term options here. Going to the left, generally lower complexity is revenue expansion. There's plenty of analysis and projects you can do to optimize your sales. You can always look to have cross-selling initiatives, add-ons you can do that will help ultimately drive top line expansion. Also, a great thing is looking at your processes. So if you think about salesmen going from request for a quote, from interest to a quote, sometimes that speed will be really long because you're lacking CRM discipline. There's maybe not like the same incentive alignment there. So that's another great way you can go and reduce like some of that overhead, because time will kill deals, and speeding up that process is often going to drive top line growth. You can also look at price volume. So what's the optimal pricing structure? Do we have opportunity to increase cost because our demand here is inelastic between these items? There's plenty of analysis that you can do that will will help prove this out and give you the opportunity to increase your top line without adding substantial operational cost. And then also, are there value-based pricing models? There's a lot you can do in this area, but generally a little bit longer on that implementation side. And then going to the right, these are more for your big strategic questions. So these are things that typically take longer, they're higher complexity, there's some operational risk to it. So sometimes you'll see when you get into your budget that maybe one of your service lines, the margin's just not there because there's been a macroeconomic shift. Maybe that's something that you've got to really rethink a business model and approach in order to be able to make up that ground. Those again are like bigger strategic questions to think through, but it's important to have that early warning system so you'll see it before it's too late. And then, there's also AI automation options. There's a lot of quick wins you can do here. One thing that's important to keep in mind when you're optimizing for automation for AI is what are the clear, traceable efficiency gains, especially in terms of cost. A lot of times you'll come in, you'll do an automation project, and then that work and hours just gets filled elsewhere, and you don't see those quantifiable cost savings. So we'll talk on the next slide about how to correctly track this so that you're actually realizing these savings, and it's not just a black hole there. And then there's also outshore, nearshore model, kind of goes a bit into org design, but generally that's going to take longer to implement than some of the studies you can do there. But what's the ideal staffing model, hybrid teams, things like that can be a great way to make up some of that gap, especially if it's especially for back office teams. And then, of course, big strategic decisions, integrations. There's a lot of different things you can do, but again, sort of a big, more strategic look. So we could do a webinar on effectively any of these, but just wanted to give a flavor as to some of the engagements and some of the options we have typically to come in and help close some of the gaps. And then lastly, before I hand it over to Craig, this is what I was mentioning on talking about the automation side, but when you're going and using your when you're going and implementing any of these projects, it's important to have, clear accountability, having a charter to each initiative that you're doing. So if you're thinking about this is really the why behind each of those projects. So it's important to have, the tools, the tracking, and the accountability in place. But using a charter like this will clearly tell you, what's our baseline spend? What are we trying to, close? How long do we have to do it? What are the real impacts, after this? So as we think about automation to reduce cost, it is this number of FTEs, this is the clear value, and we'll know we're successful in this project, not because we implemented an AI automation solution, but instead because we saw, real world cost savings and real world efficiency gains in our team. So just one of many tools to help you properly execute on some of these items and close that gap. So with that, I'll hand it back to Craig.
Yeah, and just the one last one, we typically do an aggregation of all those initiative trackers, and that becomes part of your steering committee and your monthly operating review is reviewing these all with the team to make sure everybody's aligned. So so we're kind of nearing the end here. I want to leave just a couple of minutes. I've had a couple come in through email on questions, but this is really kind of the culmination of our budgeting and implementation series. We've talked about the prep, holding people accountable, and then the executional side here. And this is just sort of the tools that we've gone through with you as far as the budget preparation, what that process high level looks like, and then the execution piece. So with that, we'll get a couple of questions knocked out here. And maybe Ben, I see a couple come in. I'll take the first one and then I'll throw one to you. But the first one asks, how do you manage the board when you're going through significant changes, reforecasting? And I think that's a great call out. And so if you remember back when I was going through the reporting package in the monthly operating review, the key there is not really the what, it's the why. And being able to give the board as much lead time for changes in performance, and then really the why. And I think the final piece there is how do you address it? How do you mitigate becomes the important pieces there. From my experience and what I've seen, boards don't like surprises, especially underperformance surprises. And the board meeting, the monthly operating reviews are not necessarily the time to brainstorm on how to fix that. It's really coming in with, here's my plan, talking through that plan and delivering, getting feedback from the executive team and the board ongoing and executing. So I think as much as you can have these tools in place, get those early warnings, understand the trends, be able to communicate the what and the why to the board, will make your job much easier. Ben, the one that I had come in, I'll throw to you is, what are some metrics that you can use to understand, is working capital actually constraining your growth?
Yeah, that's a great question. So really, you're going to want to look at your like the best way to understand this is benchmarking. So it's hard to say like is a DIO of 100 good or bad in a vacuum. There's really two ways you can think about benchmarking. The first and easiest one that most companies can do, immediately is internal benchmarking. So you can look at, sort of the best it ever was metrics. So going back a couple of years, going back, especially if you're a conglomerate, maybe you've got multiple businesses under one, umbrella. Is one of the business units with the same business line performing materially good or bad against those? But then obviously looking externally to peers is a great way to assess, how you're tracking. But really really as you think about, is it constraining your growth? The best way to tell that is through proper forecasting. So if you're looking at your revenue plan, you should really have a clear way as to how that, falls out into your statement of cash flows forecast, or on the direct side on your 13 weeks. So if you're putting in all of your, if you're putting in all of your revenue and growth plans and your operational plans, and you're starting to see your liquidity dip into the negative, that's something you want to really think about before going and executing and actioning that plan. If you are going ahead with those growth plans because you can drive the sales in that operational side, it might make sense to think about what are your strategic options. Can you restructure your debt? Can you, get a cash infusion from an investor? Do you have the ability to actually improve your DSO and DPO to free some of that up? One of the great things about having, Pegasus as a SaaS application is we can very easily real-time model this all for you. So we can see, if I'm able to improve my DSO from 60 to 55, what's my actual cash need now? The one thing I would say is make sure you're using responsible modeling, I would call it. You don't just want to, change those KPIs to make the numbers work out. If you're going and saying that we're going to finance some of this by using seller financing, by increasing DPO and reducing our DSO, you want to make sure that you actually are able to execute on it, especially as you're growing the business. Having AR clerks who can stay on top of now twice as many invoices is going to be very important for you actually being able to operationalize that. So really proper forecasting is the only way to truly tell if that's going to be a growth limiting factor for you.
Perfect. Thanks, Ben. And I've got one more to cover here, but if anyone else has a question that's here live with us, feel free to drop it in the Q&A. So where do you typically see plans break down and assumptions go wrong as part of the annual budgeting process? And I think that's a great question. And I'll just preface by saying no FP&A person has ever gotten a budget right. So it's really kind of getting behind the assumptions. And as you see variances happening, understanding again the whys of those are happening and how to remediate. I think the one key area that I would call out as far as specific to PE, I typically, when Ben covered some contingency, I rarely see contingency built into PE-focused budgets. And by that, I mean that the assumption is, here's the plan, we agree on the plan, and it's going to go to plan, and then there are additional upsides there. So I think that if there is sort of a downside, whether it be company specific or environmental, I think it's really challenging if you've assumed kind of 100% budget to make up some of that without significant planning. And that's what the tools are there for, to identify those as early as possible. But I think that's coming from also a public company background where earnings management is extremely important. We would typically build in some contingency there, but understanding it's a different environment, it's just not typically built into a portfolio company budget. So all right. Well, with that, I don't see any other questions. Again, thank you everybody for their time. Just the final slide here, QR code, if you'd like to set up a time to talk about this or other topics further with Ben and myself. And then, feel free to reach out if there are things that we can help you with. Again, no need for a project. Happy to help brainstorm any specific situations, go through a Pegasus demo, do some assessments, frameworks, and whatever you guys need. So appreciate it. We'll look forward to seeing you on our next webinar and appreciate your time this afternoon. Thanks.